Hello, and welcome to the ISDA AGM studio. My name's Mark Gheerbrant. I'm the Global Head of Risk and Capital at ISDA, and I'm delighted to be joined by Jacques Vigner, who's an ISDA board member and the Chief Strategic Oversight Officer for Global Markets at BNP Paribas. Jacques, thank you for joining us today.
Thank you, Mark.
So with various jurisdictions in different stages of implementing Basel III, what do you think are the key issues that need to be addressed in order to get a globally consistent risk-appropriate capital framework?
I would say there are two main issues with Basel III. The first one is a question of capacity for banks, and the second one are an array of technical and operational issues. So if I talk about capacity first, if you look at the EBA QIS, for European QIS banks, for instance, you can see that the capital impact for FRTB only, would be up to twice today's capital for internal approach and up to 3 times for standardized approach. So this is a lot because this means that with the same business as of today, you need twice more capital, up to 3 times more capital. And this is a big question of capacity for European banks at the very moment where we need to support the growth of Europe, all the investments needed for the competitiveness compass program of the European Commission in the wake of the Draghi report. And also, this is a concern for our shareholders. So this is the first issue. The second issue is about technical and operational flows, I would say. If I take FRTB, there are many cliff effects in FRTB. NMRFs, P&L attribution tests, maturity buckets. Really, FRTB means fundamental review of the trading book, but that shouldn't mean fundamentalist review of the trading book, meaning that we have to face the issues it raises with the experience we have now, and we have to simply fix them. And if I go beyond FRTB with other topics in Basel III, this is a bit the same. The CVA charge, for instance. In the CVA charge, you can create risk-weighted assets without any risk, simply by the mismatch between accounting and prudential CVAs. And for counterparty and credit risk, you have also a number of topics to fix, such as, for instance, for the repos. If you do a repo with a mutual fund, if you have applied the standard approach, you end up with a risk weight of 100% because it's an unrated counterparty. But if you look at the history of mutual funds over decades, across tens of thousands of mutual funds, you have hardly a handful of defaults. So meaning that these counterparties should actually attract a very low risk rate below 10%. This is a big issue for the repo market, and the repo market is a cornerstone of financial markets everywhere in the world. For the treasury market in the US, which is on the top of the headlines at the moment, for pension funds in Europe, everywhere we need a strong repo market. So these are a few topics that we need to address, and of course we need to take advantage of the work which is done in all the jurisdictions, for instance with the ongoing EC consultation on market risk in order to try to fix as many possible issues as we can.
Okay, thank you. Now, a recent ISDA survey found that probably only 3 banks in the EU and 10 or less globally will be implementing internal models under FRTB, which is considerably down on the current numbers. Why does this matter, and what are the issues that need to be fixed in order for that to change?
I would say this is a big concern for financial stability. For me, I would highlight the importance of internal models. Indeed, there are very few banks endorsing these internal models at the moment. And this is an issue. Why? Because internal models are the only ones able to fully align day-to-day risk and trading decisions together with capital measurement. On the other hand, when you are under the standardized approach, you suffer a deficit of information. Even if today the Basel III SA is better than the previous one, there is still a deficit of information in modeling the trading book, and this can lead to gregarious behaviors, biases in the trading portfolios. For me, as a practitioner of markets for 25 years, I would say, unfortunately, standardized approach is a stone age of risk management. And if we are at the stone age of risk management, it's high time we go back to the future, and the future is really internal models. What are the key issues that we need to unlock for internal models? There are two roadblocks. The first one is a so-called P&L attribution test, which is a test that you have to pass for a desk to qualify for internal approach. This is unfortunately very cumbersome. We need to monitor hundreds of metrics on a daily basis across all portfolios. This is also digital with a cliff effect, so you can fall back from internal model to SA at any time because of technical glitches. So, and if you fail for, let's say, a handful of trading desks, you may end up with more capital than if you were under SA only because of the lack of diversification of your internal model if you have a few desks failing. So this is an issue. So my personal proposal is to make P&L attribution test a monitoring tool only and not a mandatory tool. Unfortunately, this is, by the way, a proposal that is in the EC consultation. Very welcome. Unfortunately, in the EC consultation, it's only for a transitional period. I would advocate for it to become permanent. The second roadblock is non-modelable risk factors. So the non-modelable risk factors are those risk factors for which we have not enough firm prices observation. And we cannot, and for that reason, it's not possible regulatory-wise to include them in the main capital engine, which is the expected shortfall Monte Carlo, and they have to fall back to a stress test. And this stress test is a double penalty because it's very punitive, and we end up also with many broken hedges. So if you have a global trading book, you generally have to up to 100,000 risk factors. At the moment, because there are very few banks, as you have highlighted, applying for IMA, we have no data vendor offering firm prices observations. And the result is that we may end up with thousands of NMRFs. And the capital impact is huge. It would be in the same magnitude as the expected shortfall that was certainly not intended by the authors of FRTB. So we need to fix this. My personal proposal is very simple. Get rid of the NMRF framework. Why? Because we already have the backtesting framework, which ensures that, anyway, your risk factors do properly model your risk in the trading book. So you don't need the NMRFs. And secondly, you have the prudent valuation, which factors in the illiquidity of certain risk factors. So everything is fine with these two schemes, and I would simply suggest to simplify. So if we address these two topics, P&L attribution test and MRF, I'm sure we will have suddenly plenty of banks applying for the internal model approach, and that will be better, of course, for financial stability and risk representation.
Jacques, thank you very much for your insights.
Thank you very much, Mark.